Welcome into the reaction channel, folks. Got a 4-piece for you here today. Buy one, get 3 free in this video. First up here, we're in the early stages of a bull market. I want to react to this video, kind of give my opinions and perspectives here. Dan Ives. Next one up here. Oh my gosh, if we got Dan Ives on a video and Tom Lee, you know we're going mega bullish, okay? Small caps are in the process of a multi-year bottom, says Tom Lee. I want to react to that one, give my opinions and perspectives there. Then we're going to get into this one. A Fed rate cut will be the next big catalyst for new highs in the market, says Courtney Garcia. I want to react to that one. And then, since there's a lot of bullishness there, I want to react to this one. The markets are expensive, okay? You know, we gotta somewhat balance this out. You got Dan Ives and Tom Lee in the same video. We gotta balance this out with like a little pessimism here, okay? Appreciate y'all joining me as always. Thank you so much for being here. Thank you for being subscribed, folks. I just signed this morning 5 new 6-figure club award winners in my private group. So congrats to you guys hitting 6 figures plus in your portfolios. That's amazing. Alrighty, guys, let's get into this.
On the NASDAQ 100. That company reports earnings right here on Overtime on Monday. But joining us now ahead of that is Dan Ives from Wedbush. Before I get to Palo Alto specifically, just got to ask about the rally we have seen in tech. It was the strongest sector today, and it's really been leading this turnaround, this rebound, after we did see a pullback in the S&P and a correction in the NASDAQ.
It's a golden age for tech. I mean, in my opinion, we are just in the early stages of a bull market. And if you look at what we've seen from AI revolution, just from broader tech, it's been strong from an earnings perspective. And the growth scare that we saw, it's just a bump in the road to what I believe is really this fourth industrial revolution playing out. And that's how we've handheld investors through this. This is the time to own tech. And I believe it's really just the start, still 9 p.m. in an AI party that we believe goes to 4 a.m.
We're in an election cycle. We're already starting to see some of the signs of cybersecurity issues and hacks as we do move closer to that November election day. On the flip side of that, we saw the debacle with CrowdStrike a couple of weeks ago as well. So how does that position us for cybersecurity earnings when we do have Palo Alto kicking them off on Monday?
Yeah, I actually think as a subsector, it's one of the strongest ones to own. And not just into year-end, but into early 2025. In terms of what we're seeing in more and more movements to the cloud, cyber is actually benefiting. Names like CyberArk, Checkpoint. I think Palo Alto, it's actually one of our top names the last few years. It's a table.
So there's one big issue with all these stocks, Dan Ives speaking out here, and the one big issue is valuation. Valuation on all those stocks is insanely rich. Even CrowdStrike, after that massive crash in the stock, look at the trailing 12-month P, look at the forward P, even go to the 2-year out forward P of those stocks. They trade very, very rich.
In our opinion. This is a name where I think glass half empty still on the street. But now they're going for platformization. And I think when the Cash and team are doing, they're going to gain more and more share. And even when you look at the CrowdStrike situation, a black eye for CrowdStrike, Palo Alto could benefit from that.
Do you expect to see that show up in the results we get next week?
Not in terms of what we see in terms of results, but I believe as we go into fiscal 25, this is just going to be another tailwind for them. You look at that free cash flow story. This is just what I believe is sort of the second inning of this game playing out for Palo Alto. They are going to be a share gainer. But you take a step back, when you look at Zscaler, Checkpoint, CyberArk, Palo Alto.
I mean, let's pull up valuation on these guys here. Alrighty, let's go to our little new, well, it's not a new tool. We had this for about a month now, our compare feature here on 1000X. And let's go ahead and look up valuation on these guys. So Palo Alto Networks, and then we're going to look up CrowdStrike. I'm trying to remember their ticker symbol. CrowdStrike, there it is. And then the other one, he wanted to Zscaler, he was talking about, right? All right, so let's see valuations on these babies. So trailing 12-month P, Palo Alto 44, CrowdStrike 485, Zscaler has none, right? So forward P is what we really got to look at in 2-year forward P, because if we're buying these stocks, we're buying them for the future, right? So Palo Alto 60, CrowdStrike, even after the massive crash in the stock, 70, Zscaler 70, 2-year forward P, about 50, 52, 53, 51, right? Estimates there, that's 2-year out forward P. So with those stocks, that's the issue. They trade very, very rich. It's not like, sure, they have growth, like they have a multi-year growth story, but it's certainly not like you're getting those stocks for cheap prices, right? I mean, you can get Meta. Meta has a multi-year growth story behind it, right? Check out Meta here. So we go Meta. Meta's at a 21 2-year forward PE, right? And that has a multi-year growth story. So, just some things to consider there. By the way, if you want access to 1000xstocks.com as well as apply for my private stock group, I'll put that as a pinned comment down there today. You can click that and fill an application.
This is really actually just the beginning of really the second, third stages, what I view as sort of this AI revolution. Cybersecurity is going to be a big beneficiary there. So I think as a subsector, could be the best outperformer going into year end.
And something I think that gets overlooked sometimes, you and I have talked about it,
Sure.
is the growing government book of business for some of these cybersecurity names. I mean, you saw it, they're a different piece of the AI software business, data analytics, Palantir, but you've seen it with Palantir recently as well. How meaningful is it to be seeing the federal government dole out more of these contracts?
I mean, and we've talked, the 202 area code, it is just a different mojo that we're seeing from a spending perspective. Look, Palo Alto, Messi of AI, you saw it firsthand in terms of what they're doing. Government is now really more and more focused on AI, next generation technology. That's going to benefit not just Palantir, it's going to benefit Oracle, going to benefit a lot of the cybersecurity names like Zscaler, and names like Palo Alto. And that is going to be for the September quarter important, especially in that fiscal year end.
Alrighty, next one up here. Small caps are in the process of multi-year bottom, but let me just say real quick here before we move on. Do I feel like it's early stages of a bull market? I don't know if my face is actually frozen or not, but because for me it looks like my face is frozen, but maybe it's not. But am I feeling early bull stage? I think it's way too hard to make that call. I think a lot of people are trying to run to these conclusions of we're late stage or we're early stage, and I just don't think you have enough clarity on either side to make a justification like that. Small caps are in the process of a multi-year bottom. Tom Lee
joins us here at Post 9 on a summer Friday. Tom, thanks for coming in.
Great to see you.
Was it last week? Was it difficult to keep your bearings in the midst of that crazy price action?
Without question, because the market had been whipsawed by data point to data point, as you guys were recapping. The job support raised recession fears, big risk off. Then we got inflation this week, which was pretty tame, and I think markets suddenly went back to thinking about liquidity coming into markets. I think that the data dependence of the markets and the Fed is very tough for investors. And I think if you look ahead, I'd say we always know the summer is tough. Summer probably runs through October, but I don't think that anything's changed into year end, which should look pretty good.
But are you lower conviction now than you were 2 weeks ago?
No change in our conviction, but it is just recognizing August historically is a tough month for markets. I mean, one thing that maybe investors can be encouraged by is since 1928, the most common month for the summer low is August, and the most common week is the first week of August. So I think maybe the worst is behind us, but it doesn't mean we're straight up from here.
Right, and I guess the question is, I keep going back to, that moment in mid-July when we were at the highs. You were just shy of 5,700 on the S&P 500, and everything was a go. It was, the AI earnings path was kind of unquestioned. In addition to, general soft landing expectations, you kind of didn't have a lot of painful trade-offs to worry about in terms of policy or growth. Can we get back to something like that? I guess the idea, as you say, maybe summer lasts through October. Do you expect that we're going to have to continue to reset around these levels?
Yeah, I think if my best guess would be it's still going to be a struggle, but we're climbing the escalator again. I think Jackson Hole is going to set a positive tone on balance just because the evidence is growing. FOMC members want to be forward-looking, as you guys are pointing out. Data dependence is dangerous at turning points. And then we get the jobs report for August, which I think should reverse some of things that could be temporary. I mean, that's a guess, and if it is, then recession risk is sort of reduced. But now we have real rates are too high, and that means investors will be comfortable with cutting.
I'm thinking back to some of the notes you wrote after the last jobs number, and you looked at Hurricane Beryl and the number of companies in Texas that had no power for 2 weeks, and you do think August will be reassuring on the NFP print?
Yes, I mean, in some ways, the weekly claims is telling the story. We had a surge in claims, multi-month high that have come down since then. And so even if someone says there was no effect from the hurricane, how do you explain claims really improving so much, especially in places like Texas?
Holy smokers, that ain't no dang jokers. Look at that move. Oh my gosh. Literally in less than 2 weeks. What a move. It's got to be one of the strongest moves I've honestly ever seen in the S&P 500 in a matter of less than 2 weeks. Like literally one of the strongest moves I've ever seen. Incredible.
And, a million homes without power for 2 weeks, how could that not affect the local economy and the jobs market?
This rebound that we've gotten from the lows of early last week, initially, certainly until yesterday, it was back to the first half winners. It was a lot of the mega cap growth stocks, and the equal weight S&P really didn't have that much of a pullback, and it's getting closer to its highs. But small caps definitely got a flush, and yesterday they rallied big on that retail sales number.
All right, I don't know if my screen is frozen or if it's frozen for you guys or whatnot, but for me, my little picture, it looks frozen. So I don't know. I don't know. But whatever. It's all good. It's all good. A lot of people I would say probably half the people that watch my channel just listen to it anyways. They don't really actively watch it. They just listen. But you have to let me know in the comment section if my face got frozen for you guys too or not.
It seems like that's still been a complicated attempt at a rotation.
Oh, that's right. They always say bottoms are tough. And bottoms are a process, and small caps are really in the process of what we think is a multi-year bottom. And so conviction is not going to be as strong as things that have been working. I think most people's toolkit is to buy the triple Q, the NASDAQ or the AI names when they want to get back in the markets. But cutting rates at a time when small caps trade at 10 times forward PE, better earnings growth, and then a visible path to easing, I would say it still makes sense that the risk reward is in small caps.
And then, we had a miss on housing starts this morning.
So he's talking here about a multi-year bottom for small caps. Now, what I'll say about that is it a possibility? I gotta say, it's a possibility. And here's why. If you go back to look at kind of what happened after we had the tech stock crash, right? Valuations came down massively in that situation. We technically had a little recession in if I recall, it was 2001, right? And that was what it was. We kind of came out of that, and then the economy started to grow again. And so, is that a potential? I think there's a potential people have to factor in, right? It's certainly no guarantee, but is it a potential that we've kind of been in a multi bottom? We started the bull rally in small cap back in October, November of 2023. And then, things will just continue to rally overall for the next 2 or 3 years. It's a potential. It's something that has to be factored in. As I tell you guys all the time in regards to the market, you have to factor in several different cases whenever you're thinking about the market. Too many times people just assume it's only one way, and that's just, no, it doesn't work. It doesn't work that way. You have to assume many different scenarios. Assuming it's only going to be one way is a recipe for disaster.
So it's funny, is the parts of the economy you thought you could rely on for a while, maybe are giving way as other ones maybe start to bottom. But what's your thought there in terms of the flow through to the rest of the economy?
I think housing, auto sales, and durable goods are essentially in recession. Mm-hmm. It makes sense because cost of money is so high. I mean, it's super expensive and hard to afford a home or to buy a car with these rates. These are
housing starts. So what I'll say about housing starts here, I'll say two things. One is housing starts have been incredibly high here over the past couple years. We all know that, right? Additionally, it is a potential here, and I'm hearing what some of these home builders are saying as far as their new sales go. It's a potential that we could see housing starts actually recover over the next, I would say, 3 to 6 months. So, just another one of those million things you got to factor in here.
Also directly benefiting from Fed cuts because adjustable rate mortgages adjust, business loans adjust, auto loans, credit card, they're sensitive to short-term
builders
rates.
Loans too. I mean, if you're building
that's
a house.
Right. Cost of money for builders, yeah. And so I think these really benefit from an easing cycle, but a market that believes there's an easing cycle underway.
How many cuts you think we get this year?
I'm looking at consensus, which is somewhere between 4 and 5.
Before the end of the year?
Yes.
So about 100 basis points?
I think that's right, but it depends on where inflation prints the next couple months. But our base case is that we're on a glide path towards 2%. That's better than consensus. So I think 4 to 5 still makes sense.
And you've been
So let me. He can finish out, and then I'll talk about kind of what I'm expecting the Fed to do here.
part of your thesis has been that elements of CPI have been falling, in your words, like a rock.
Yes.
I actually saw that phrase repeated in another desk note yesterday, so that's spreading. But are you as assured of that? And when you look at things like car insurance or some of the coincident costs of owning a vehicle, as you point out?
Yeah, I think one of the things that surprises us still is that two things are keeping inflation high on a weighted basis: shelter and auto insurance. Auto insurance adequacy is there now. If you look at the results from these auto insurers, they don't need to raise rates. So I think that's cooling, and that'll come in the second half. And for housing, rent is stabilizing, and I think housing is going to cool. It just needs to get to 3 to 4%, and then markets will be comfortable that we're back at 2%. But median inflation rate is still 1%. That's below Fed's.
Well, I think as Greg Ives said this week, rents are inertial. It takes time for those new rents to cycle in.
Yeah, that's right.
100%.
Here to break down the road ahead.
I think Tom Lee's a little premature in regards to his call about auto insurance kind of rolling off second half of the year. I think that's going to be more of a next year story, 2025. Now, in terms of his call about, in regards to the Fed, right? He's talking about the Federal Reserve cutting around 100 basis points for the remainder of this year. I think this is definitely a possibility. I think they could go 50 here next month and then another 50 either in November or December. So I wouldn't be surprised at all, and I think that is a move they should make. I would be disappointed if the Fed only went 25 basis points. I'm like, why would you only go 25 basis points? Look at where CPI is. CPI is at like a 2.9 number. You're at a Fed funds of close to 5.5, right? 5.25 to 5.5. We have a massive divergence in between where the Fed funds rate is at versus where CPI is. It's way too high. So why not start bringing it down a little more considerably, bring it down 50 basis points at a time. So you get to the end of this year, you got a 100 basis point cut. So then we're at 4.25 to 4.5 Fed funds. And then we can say we'll play it how it goes next year, right? Inflation keeps coming in really good, and the economy is not like booming or something like that. Let's keep bringing it down 50 basis points at a time. If you have an emergency in the economy or something like that, you can obviously bring it down faster than 50 basis points. But I think that's about appropriate. And then you could probably, as long as the economy stays decent or maybe even strengthens a little bit next year and inflation stays in the twos throughout the year, and when I say twos, I'm talking CPI, I think you could be looking at probably next year about 200 basis points of cuts, which would then by the end of 2025 going into 2026 would put you probably 2.25 to 2.5, somewhere around there, which is where you want to be if you're the Fed, right? And then we'll play it how it goes in 2026. How's the economy doing? How's inflation doing? If inflation comes back, then obviously we can't lower rates anymore at that point in time. If inflation's chilling, economy's looking good, you keep rates the same. If economy's faltering, you cut rates down to zero if you really need to. All right, next one up here. The Fed rate cut will be the next big catalyst for new market highs.
See, both are here at Post 9. It's nice to have both of you back. Court, so what do you make of this market? I think its hallmark will go down to be, the bull market anyway, one of resiliency. I mean, at every turn, you throw almost anything at this market, and it shrugs it off and continues to do what it's doing.
Yeah, and I think the downturn that we had about 2 weeks ago, there was fears that was because we were going into recession after you got a bad unemployment number. But the fact that you're seeing the markets really shrug that off is because you're getting a lot of good data. We got CPI coming out, PPI coming out, you got retail sales. The big picture is that the consumer is still holding in there. Inflation is still coming down. And a lot of those recession fears are likely overblown. And that downturn we had was more likely due to that yen carry trade than us going into recession, which would be a worse thing for the markets.
Yeah.
And that I think is ultimately going to put the market's on a positive backdrop.
All right. Kevin, you see it the same way?
I'm not so sure that, when you look at the sell-off, the sector action wasn't telling me a lot that the market was expecting or fearing a recession. When you look at the sectors that were underperforming the broad market, the S&P, in that period, the entire drawdown from mid-July to early August, it was just tech and consumer discretionary. Both of those driven by a lot of mega cap weakness, which actually preceded the peak in the market and that kind of waterfall move down. Yes, you did see some weakness in cyclicals, but there wasn't this message from financials or industrials or materials that you were going into this recession. So I understand the fears around, why the jobs report came in, worse than expected and the uptick in the unemployment rate. why that could send some fears into the market, but I'm not so sure that the message has been one of recession. I think it was definitely exacerbated by tech.
Last Monday specifically, there was a panic attack that we not only were having a positioning unwind, but that we were, in fact, maybe closer to a recession than we thought, because the employment report the prior Friday sort of set everybody off. And then we opened Monday and you had that confluence of events, not to mention Buffett selling half of his Apple stake. And we're like, okay, what's going on here?
I think even with that, though, I mean, it was amazing to me to look at some of the reactions to the jobs report itself as if all of these problems just started to crop up out of nowhere. I mean, we've known that.
I mean, we're going to be quite clear about Buffett's move. And as somebody that's studied, I mean, pretty much every Buffett move even prior to me being in the stock market, right? I've got to say, I don't think Buffett selling Apple was a play on, oh, there's going to be a big recession, I got to get even more cash than I already have. I believe it was a play on, I believe Buffett is very fearful that a lot of things are going to change in regards to Apple's business model for the negative in regards to the financials because of the government coming down on them. We know the Justice Department announced they're coming after them. That was back in March. And then suddenly, April through June, Buffett's selling left and right? You know, you put those two pieces together, and I would say it's a high probability that Buffett was selling so many Apple shares because he believes that Apple might be a stock that stagnates for a long time. Which is kind of scary when you're a tech company, right? Because then you could be talking about what if you stagnate for 5-6 years because the government cracks down on you, they call a bunch of your practices monopolistic, right? And you have to change a bunch of things and so your financials go very negative in regards to profitability in over a few year span. So then you have to climb back from that, right? And if simultaneously, you know, you got a little bit of a richer valuation, which Apple does, it trades in the 30s now when it comes to forward PE metrics, right? If I recall, Apple, I want to say the forward P is like 32 or something insane on Apple, which is, you know, very high for Apple. Apple hasn't traded. I mean, look at that forward P. Look at the 2-year out forward P, 30. And then, you know, what happens if the smartphone gets disrupted 5 years from now, 10 years from now, right? And Apple's positioning is disrupted. What does that mean? Apple's at that, you know, I think there's a lot of risk factors there with that. I think there's a lot more risk factors with Apple than there are other stocks. Now, for the very short term, I think Apple sets up pretty decent because they're going to have a very strong next year when it comes to iPhone sales, right? They're supposed to come out with the biggest iPhone ever. It's usually always very strong for Apple sales whenever they come out with the biggest iPhone ever. But you know, I think Buffett obviously isn't just worried about the next 12 months with Apple stock. I think he's thinking about the next, 5, 10, 15 years. And so that's my personal opinion on that. He might think the government actually has an angle here and they're going to actually change Apple's business model for a negative.
Employment rate has been drifting higher. Payroll growth has been softening. There have been massive cuts to the work week. Cyclical hiring has been slowing. You know, the list sort of goes on. That's been the trend over time. So I don't think there was any one particular thing in the jobs report, excluding the uptick in the unemployment rate. But even with that, I think that there's not a lot of supplemental labor data that are yet confirming that. You can look at the trend in initial jobless claims. That's starting to roll back over, not confirming the uptick you've seen in the unemployment rate. You can look at the employment to population ratio on a prime age basis. That's rising. Doesn't happen when you go into recession. So there's enough there still in this unique cycle, which I think we have to keep in mind from a labor supply perspective that is skewing a little bit different this time. I don't want to completely ignore the unemployment rate risk, but I think it's an important, sort of nuanced look at the labor market for this particular cycle.
When I asked the question at the top of the show, are we going towards new highs again? And are we going to be able to eclipse? I mean, we're only 2 to 2.5%.
Yeah, I think
away from that.
Yeah, especially when you look at what's been leading us off of this low. It's been tech and consumer discretionary, which is not surprising given they were sort of at the epicenter of that selling pressure. But if you get more of these clusters of days where advancers relative to decliners, are really strong, kind of in that 6 to 7, 6 to 7 advancers relative to decliners range, I think it's plausible to see that.
Whoa, that's insane! Look at the Nasdaq. Look at the Nasdaq off last week's low, 12% up. S&P 500 off last week's low, 8 point. That's what I told you guys. Like, this is one of the strongest bounce backs I've ever seen in the stock market since I've been in this game. That's insane.
The key, in my opinion, when you get to that next all-time high, whether it's a week from now, a month from now, is what the breadth picture looks like under the surface. And so far this year, I think one of the strongest aspects of this market has been the fact that when you look at the percentage of companies in the S&P above their 200-day moving average, you've kind of hung in at the 60 to 80% range, 60 as a solid floor, 80%, 85% as a ceiling. And I think as long as you can keep that, you probably keep everything intact, especially because you now have the added benefit of inflation not only rolling over again, but inflation surprises being much more tame and much more muted. That tends to be a really positive backdrop for the equity market.
Corey, you would agree then with J.P. Morgan and sounds like Kevin Gordon, the bullish narrative remains intact. That was the headline of one of their notes today, and they do talk about rate cuts being a welcome sign. Some people suggest, sell the first rate cut. And I think they're implying that, they're cutting because the economy is softening, whereas others would counter with, no, they're cutting because they're just too restrictive and things are working in their favor, so they can and should.
Yeah, and I would agree with the latter there. I think you're really seeing the idea that rates are coming down is more so because inflation's coming down as opposed to the economy being in a bad position. They need to prop it up. That would change the picture if that happens. That's, again, I think what people started to question about 2 weeks ago, but we really haven't seen that be the case. And I think, too, as you're looking forward here, if the Fed does, in fact, cut interest rates, there is still record levels of cash on hand right now. I think we're at like 6.2 trillion or something in that range. And if rates come down, you're not going to be getting that 5% interest rates any longer. And you're going to start to see some of that.
Yes, and that was as of last quarter. Like, that's way lagging data. If I recall, the last time we got data on that was for ending in March, okay? Last time I checked, we're in August. So my opinion is, if we were to look at if we could see the actual numbers right now, I don't think we're at 6.2 trillion. I think we're probably at 6.5. I would say 6.4 to 6.5 trillion dollars over there right now. So, yeah, it's no small amount, that's for sure.
And I know we've talked about this for a while now, because the question is when that's going to happen, but that really will probably be the next big catalyst to see those markets go to new highs.
Yeah, and you know, the important thing I point out in regards to that is a lot of people assume, like, the whole $6.5 trillion. Like, let's say when the Fed starts cutting, we're at $6.5 trillion. A lot of people assume like that $6.5 trillion is going to come in the stock market. No, it's not. The far majority of that's going to remain over there. Now, as rates come lower, could you see $1 trillion come off that 6.5 and make its way into the market over a 12 or 18 month span? Sure. That's possible. But if you're expecting all 6.5 trillion to roll over the stock market, you're just sorely mistaken. That's not the way it works. So, yeah.
Back on another positive note, the S&P 500 now just 2% from record highs.
Five.
Value stocks even closer to that milestone, just 1% from an all-time high set 2 weeks ago. Noted value investor Scott Black joins me now to share where he is investing. He's Delphi Management's president and founder. It's good to see you. Welcome back.
Thank you for inviting me.
We mentioned in the tease to this segment that you think the market's exhibiting some euphoria. In what sense?
Okay, if you look at the PE ratios, let's take the NASDAQ, for example.
I already like them. I mean, when a man starts out the conversation by, okay, let's look at the PE ratios, you won me. You won me over, sir. Aye, Captain.
27 times this year's earnings. The Russell 2000 is 28 times, and based on my calculation of 235.
So this is where it's funny. He's talking about 28 times Russell 2000. Tom Lee was just talking about 10 times. So who's lying? Who's mistaken here, right?
The Russell 2000 is 28 times, and based on my calculation of 235 and S&P 500 earnings, the market is about 23.5 multiple. And if you look at the concentration, the NASDAQ, the top 10 stocks are 50%, and almost 38% in the S&P. With the exception of Meta and Alphabet, every one of those other 8 out of the 10 are selling between 33 and 90 times this year's earnings. I'm not saying they're not good companies. They're excellent companies, but these are full multiples going in. And what's happened is I think people are concerned that, we're going to avoid a recession, that the Fed's suddenly going to drop, cut the rate, which I suspect they will, 25 basis points, although they haven't reached the 2% inflation target. So that's mixed in, the imminent cut. I think they like what they saw with the consumer was up 1% this year, up month over month. And as I say, the headline CPI number was under 3%. The actual X energy and food was 3.2. So I think there's just too much expectation already baked in. And the S&P estimates are much too high. When I did the Barron's Roundtable in July, they stood at 241. They're already down to 238. And that would imply that the back half of the year, the S&P operating earnings will be up over 18%. Hard to believe, because in the last quarter, they're up 7.1. So if you put it all together, it seems to me that markets are expensive.
Okay, well,
So would I agree with this gentleman about the markets being expensive? I would say yes. If I was to grade the market as a whole, would I say the market's expensive? Yes. Especially you got to always factor in where the Fed's at right now, right? And so I would say yes, the market's expensive as a whole. But with that being said, there's incredible values and deals all over the market. So this is, in my opinion, we've kind of entered a market. I think this decade might be marked the decade of the stock picker. I think that's the real thing. Whereas 2010 through 2019, a lot of stock pickers like myself and other folks, we did phenomenal, right? And I can make an argument that every decade's a stock picker. And, if I look at where I started 2000, that 2010 decade, in where I left that decade, at the end of 2019, it was like I went from nothing to something. Let's just put it that way, right? And if I think about this decade, I think this is going to be an extreme decade marked by the decade of the stock picker, right? And not just put money blindly in S&P 500 index fund, because when it's all said and done, I wouldn't be surprised if this decade the S&P 500 underperforms its historical average. And the reason I say that is we went into this decade with S&P 500 that had done phenomenal for a long time, and I think there's I would call it like a 95% probability we do have a major recession at some point in this decade. It's just predicting what year it's going to be, 2025, 2026, 2027, 2028, 2029. I think predicting that, very difficult, what year it's going to come. But I think we will have a major recession. So I don't think S&P 500 is going to have the best decade this decade from a return standpoint. But I think there's going to be some stocks that are life-changing stocks throughout this decade, right? And so I think when we'll look back at this decade, and also remember, if there's going to be a major recession, which I expect there will be a major recession at some point in this decade, right? Just getting that timing right is going to be the difficult part. There's going to be so much money to be made from the downside. It's going to be incredible.
So it says to me, you're such a famed value investor who doesn't find much value in the market. So what is that?
Like my opinion is in this decade, there's going to be two ways to make life-changing money. One is you're in the right stocks specifically that are kind of changing the game for their futures and are going to have revenues and net income flying much higher over this decade. And then the second way I think the fortune is going to be made in this decade for some that know how to play it right will be from things like put options and other strategies that will be employed when we do have the major recession at some point this decade, which will be the big unemployment cycle that extremely high probability we have that.
Are you waiting for a significant pullback you think is coming before you would deploy any capital to the stocks you have your eye on?
No, we always stay fully invested. We're about 90 to 93% invested at all time. At this juncture, we're about 92%. But at the margin, it's getting increasingly difficult to find companies that have high returns on equity, strong free cash generation, selling at low multiples. Because we like companies that aren't in a turnaround situation where you have about 2 or 3 quarters of down earnings. So, the typical PE at Delphi now is about 12 times earnings, which is half the market multiple.
What's your best name right now?
Well, I sent you one. It's called SS&C Technologies in Windsor, Connecticut. It's a little fintech company. Most people don't know it, but it's about a $17 billion market cap. The stock is around $72 a share, and they're going to earn about $5.75 next year, so it's about a 12.5 PE. The company generates close to $1 billion a year in free cash. They basically have authorized another $1 billion buyback, and they're strong. With private equity and hedge funds, they're the
SS&C. SS&C, huh? Let's see here. I gotta say, this is definitely a stock no one ever talks about. Bravo to him for that. Forward P14, 2-hour Forward P12. It looks pretty attractive. Wow. Not the most exciting revenue growth story, but it looks like it should be pretty consistent here if analysts are correct with their numbers. The earnings per share, though, looks very attractive this year, next year, as far as that growth goes. Looks like respectable gross margins, a little under 50%. Net margins, 13%. So they might have some room to get that up over the coming years. Yeah. I don't know anything about this company's business model, but as far as if I was just judging it off of kind of these financial metrics, I would say that is actually a very attractive stock. But do they have some sort of disruption coming in their business? That would be my big question.
Strongest asset facilitator in terms of back office, algorithms, marketing to market. They're also the largest transfer agent in the mutual fund industry. The company's not a barn burner on the top line. It grows 5 or 6%. But they've increased the operating margins. They picked up about 170 basis points in operating margin this year. And so you get operating leverage plus buyback. Instead of having 5% top line growth, that translates into about 11% bottom line. I just think it's awfully cheap at a 12 multiple or 20% return on equity.
Okay. Do you still like some of the other picks that you made for the roundtable? Like
absolutely.
Everest and Diamondback and stuff like that?
Absolutely. Every one of the stocks, 4 in the first session and 2 the summer session, all 6, we own all of them. Well, I want to point out, although global payments is down, they've come in with record earnings quarter after quarter. It's the old Ben Graham in the short term.
I can already tell what type of investor this man is. I knew what type of investor he was as soon as he started out the conversation talking about P/E ratio. That's right. Let's see this global payment network. Holy smokes, look at the valuation on this one. It's definitely a beaten down dog. Forward P of 9 on this baby. 7.9, a 2-year out forward PE. If we look at current year expected earnings per share growth, insane. Next year expected earnings per share growth, still insane actually. But geez, where's the revenue at here? The scary thing with these sorts of companies is, and this is, value investors sometimes can be a little snarky. In terms of they talk in terms of they think they have it all figured out, right? And that growth investors are just crazy speculators, and it's ridiculous. And yeah, they're making a bunch of money, but they're just crazy. No. I see the faults in both sides. I see the faults in the growth investors and the faults in the value investors. The faults with the value investors is they get too caught up into the PE ratio, and they say, "Oh, this company makes so much money." They don't factor in that. Listen, if your revenue is only going to grow 1% or 2%, you're looking at potentially negative here very soon, right? And that means there's got to be some sort of major disruption going on in your business model over this next few years, which is not going to be good for you, your business, your profitability, your future revenue, right? Because let's be honest, no company is only going to be growing 1% or 2% revenues unless you're going through a major recession in that industry, which payments is not going through a recession, right? Or if there's a situation where you're being disrupted. So, that's something that has to be factored in here.
It's a voting machine. In the long term, it's a weighing machine. It's ridiculous that global payments, who's growing at roughly double digits on the bottom line, sells under a 9 PE. Each one of these companies, if you look, had up.
Yeah, but sir, look at the revenue. I mean, people are going to assume this company's going to start going negative. And then if you start going negative, you're going to be in a vicious cycle. And then what does that mean for your 5-year and 10-year returns if you start having your revenues go negative?
Not quarter, year over year, both in the first and the second quarter of the year. And they all sell at relatively low PEs, anywhere between 8 and 12 times next year's earnings.
Alrighty guys, I hope you enjoyed today's video. If you're looking for access to 1000xstocks.com, we have our search feature where you can just focus in on one stock, all the different ratios, metrics, so you can make judgments if stocks are undervalued, overvalued. We have our compare feature now. You can compare 3 stocks against each other. We have our earnings call tab. Ooh, is that baby beautiful? You can adjust the speed of earnings calls. We have our SEC filings now as well. We have our valuation. Ooh, I love this, where you can choose future growth rates of a company, net income growth, and you can do all the math. So we can say, 7%, and then we have 8% and 9% and 2%, right? And you can make all your justifications. You can choose PE ratios to kind of figure out where a stock is likely to go in future years. We also now have our financials tab, which we're still working on and finishing this baby up right now. The devs have been doing a great job on that. We have our metrics section that goes all into the different metrics, explaining what everything is. We also have our education section now that has all this: how to decode a balance sheet, how to decode an income statement, how to decode a cash flow statement, how to perform SWOT analysis, strong moat versus weak moat, how to value a dividend stock, how to value a growth stock, dividend investing 101, portfolio management. Woo, baby. If you want access to that, pin comment down there, apply to get access to 1000X, my private group, my private wealth group, all that good stuff. Much love and have a great day.